Welcome to the CBDC video series, a way for regulators, researchers, and international organizations to learn more about stablecoin technology, design, and policy considerations.
Great, we are live. Perfect. Welcome everybody to first talk about stablecoins. We want to give you an overview of stablecoins, what stablecoins are, over the different types of stability mechanisms, also over the different types of risk with stablecoins in this stablecoin series. And as you can see, this is a first talk out of 3 on stablecoins. And this first talk is about the overview on the different stability mechanisms we have out there. My name is Markus. I'm working on Celo, and on Celo I'm focusing on protocol economics and stability. Before I worked in finance all my career. I also did a lot of research in economics, did a PhD in economics, and now since 2 years I'm working on Celo. I mentioned that this is the first talk out of a series on talks about stablecoins, and the 3 different talks we will have is this first one today, the overview on the stability mechanisms. The second one is then focusing on Celo stability mechanism. Celo is an algorithmic type of stability mechanism. We are going to talk about the type of stability mechanisms, as I said today, then focus on Celo's stability mechanism. And then the last one is a talk about research on how you can simulate risks in the stablecoin world, how you can also simulate demand for stablecoin, how you can simulate the blockchain or cryptocurrency market. We did extensive research there, and this we want to share with you in the third talk. For the talk today, we will introduce the core differentiation of different stablecoins. I think this is very important since the term stablecoin has no established international classification. It's not the same classification everywhere out there, and therefore we can think about the core differentiating factors of stablecoins and what the different mechanisms of stability are, what risks are inherent in those different types of stablecoins. Currently, emerging stablecoin have many of the features of traditional crypto assets. We will also talk about these features in other talks in this series. But what is common for stablecoins is that they seek to stabilize the price of the coin by linking its value to that of an asset or to or a pool of assets. Stablecoins can differ between each other. They can differ according to the exchange rate policy. They can differ according to the underlying. They can differ according to the nature of the claim users have. Also the redemption pledge offered by the stablecoin providers. And yeah, we want to talk about these core differentiations first, and then dig a bit deeper into the stability mechanisms of 3 types of stablecoins. One is the first type we want to talk about is are fiat or commodity-backed, or fiat or commodity collateralized stablecoins. The second one are crypto-collateralized stablecoins, and then the third one are Seigniorage style or algorithmic stablecoins. And then we want to give you an overview of these different types. So we will start with the core differentiations between stablecoins. And before we go a bit deeper into that, we will have a look on at the relevance of cryptocurrencies, because this has to do a lot with why you can see so many stablecoins now emerging. Because in the end, despite many potential advantages, for example, in terms of settlement and efficiency of cryptocurrencies over fiat currencies, people have been very slow to adopt cryptocurrencies as a medium of exchange. And in the left chart, you can see the market size at the beginning of this year of different asset classes. Of course, this is a figure that is very volatile and now already has changed significantly. But you can see in relative terms that cryptocurrencies make a very small part of the overall market sizes when comparing it to equities or government debt out there. You can also have a look at the average daily turnover in different currencies. And when you compare the US dollar, the euro, the yen with different cryptocurrencies, you can see that this is still a very tiny fraction and only a few people use cryptocurrencies for transactions. And we think a part of the reason why this is the case is that cryptocurrencies typically are very volatile. You can look at the volatility by looking at historical prices. Here, this is a chart of historical prices of different cryptocurrencies over 9 years. And what you can see here with the extreme rise of the Bitcoin price in 2018 and then a drop afterwards, especially during 2018, you can see that at least one of the functions of money is not fulfilled by the cryptocurrencies or the standard cryptocurrencies out there. You can probably the function of being a store of value is not fulfilled by a currency that has this high number of volatility or this broad range, because in the end, if you want to buy goods that still have prices that are accounted for in fiat currencies, like in the US dollar or in the euro, it is difficult to store the value in Bitcoin. And therefore, many have talked about these currencies more as a sort of speculation instead of a store of value. And when looking at other figures around volatility on this chart, you can see the at the money implied volatility of different maturities for Bitcoin for this year. So these are numbers for the year 2020. You can also see that in March, these implied volatilities spiked extremely, and this is something which happens very commonly. And then maybe one last slide on the volatility and if different cryptocurrencies can be a store of value. When you look at just at the year of 2018 and you look at the development of $100 investment in different cryptocurrencies in that year, you can see at the end of the year in many currencies, also in Bitcoin or Ethereum, there was not much left. And therefore, many of these first wave of cryptocurrencies have so far failed to provide a reliable means of payment or a reliable store of value. What you can also see here in the middle of this chart is in this purple line DAI, one so-called stablecoin. And as you can see, even in a year which was relatively extreme, this stablecoin kept its price more or less. So we can see from existing cryptocurrencies why stablecoins have become so popular. Typically, many of the cryptocurrencies out there have high volatility, and therefore there is use for stablecoins. And stablecoins are in the end complex constructs or complex ecosystems that can differ very or differ between in design. And the value of a stablecoin, and this is, I think, something which is common for different types of stablecoins, is typically related to an asset or portfolio of underlying assets. So it could be that the value of a certain stablecoin is related or tracking the value of the US dollar. So it's a stablecoin that it's tracking this value, or tracking the value of a certain commodity, and this is then when people refer to it as a stablecoin. And to differentiate between different types of stablecoin, I adapted here a framework from the G7 working group on stablecoins. This is a publication by the Bank of International Settlements, and they are talking about that stablecoins can vary in their type of user interface. So it can have different types of wallets. Different stablecoins can also be traded at different exchanges. Stablecoins can be accepted at different resellers in certain countries or just in a certain industry. There are different service providers, and therefore the user interface between stablecoins can vary. However, also the transfer mechanism of stablecoin can vary significantly. Stablecoins can be, for example, based on a distributed ledger technology. Stablecoins can be permissionless, which means anyone can be a validator on the blockchain that is used to transfer this stablecoin. It can also be permissioned, so it can be that only selected entities can be a validator. It can be a public ledger. It can also be a private ledger that is only allows selected entities that can initiate transactions. It can also be a hierarchical or non-hierarchical ledger. So it's depending on who can basically see the ledger and can see every entry in that ledger. Stablecoins can also differ by their technology in terms of being open source or closed source. So open source meaning that anyone can suggest edits to the source code, or only authorized developers can edit to the source code. And then the last part, how stablecoins can differentiate, is they can differentiate in terms of the issuer. It can be a decentralized protocol. It could also be a central bank. They also differentiate in terms of governance. Is it on-chain governance? Is it distributed governance? It can differentiate in terms of technology. Are smart contracts enabled on this blockchain? As I said, there can be different underlyings. So a stablecoin can be pegged to the US dollar, to the euro, to the shilling, but also to gold, physical gold, for example. And of course, they can be different in terms of their stability mechanism. And this is basically what we want to focus today on. So looking at different stability mechanisms, as I said, today we differentiate between three stability mechanisms. One is fiat or commodity-backed stablecoins, or crypto-collateralized stablecoins. And then the last one, Seigniorage style or algorithmic stablecoins. The first on this list are called basically fiat collateralized stablecoins. These tokens basically act as IOUs for fiat currency held off-chain by a centralized custodian. Looking at this specific type of stablecoin, this type of stablecoin is typically backed by off-chain assets. As I said, it could be, for example, fiat, it could be commodities, it could be physical gold. There are stablecoins that are backed by a combination of different precious metals. And the most common type of these stablecoins are the ones that are backed by fiat. And with this type of stablecoin, users typically have a direct claim on the issuer or the underlying assets. And the provider of the stablecoin basically pledges to redeem coins at par in the same currency that was used to purchase these coins. This collateral typically sits at a custodian or in a bank, in a safe somewhere. And the stablecoin is created into existence by sending the collateral, in the example of fiat-backed stablecoins, sending fiat to this centralized party. And you can also contract the amount of stablecoin by basically destroying it when the centralized party returns fiat to the token holder. Thinking about the stability, the transparency, and the governance, this type of stablecoin, of course, depends on the value of the collateral that is sitting, as I said, in a bank or in a safe somewhere. It also depends on the liquidity of the collateral. Can it be easily liquidated? Could bank runs occur if it's sitting in a bank, if it's fiat, and everyone wants the fiat back at the same time? Could it be that this bank would get into a liquidity crunch or liquidity risk? And of course, it also has some inherent counterparty risk. A bank is holding the collateral, or a safe is holding the collateral, and therefore, if the bank goes bankrupt, there is a risk of not getting basically this collateral back or not back at par. Having collateral off-chain also means that there are audits required on this collateral to show the interested public or to show every stakeholder in the system that this collateral is actually in place. It could also mean that audits are required on the counterparty. Again, here the counterparty risk comes into play. If you think about a bank holding fiat as collateral, this is actually credit held by a bank with a certain credit rating, and therefore this risk, this credit rating, should also be taken into account when pricing this stablecoin. And as I said, the redemption process, of course, depends on the liquidity. It depends on, and the pricing should always factor in all these risks. There are many different examples for this type of stablecoins. One of the most prominent examples is Tether. Tether rose significantly in terms of market capitalization also this year. I think this year the market capitalization of Tether is more than 7 billion in circulation. And you can see that especially in times of high crypto or crypto volatility, then the market basically goes into a risk-off mode by then holding more of this type of stablecoins. There are, of course, many other examples. There's USDC, there's Paxos, there's Tiberius, Digits. So there are many different projects that issued fiat or commodity-backed stablecoins, and how they are different from each other are basically along these items we discussed, basically different in terms of the collateral. Is it fiat? Is it something else? For example, physical gold. And they are different in terms of, is it like audited? What is the counterparty risk of the bank, and so on. A second type of stablecoins we want to discuss are crypto-collateralized stablecoins. As the name already suggests, now collateral is not physical commodities or in a safe or fiat in a bank. This time here we have on-chain collateral. So thinking again about the type of stablecoin we have, it is typically the on-chain or the stablecoin itself is minted into existence via loan instruments. So basically, in many different ways, these crypto collateralized stablecoins are structured. Typically, users can borrow stablecoins by locking up other cryptocurrency holdings as a collateral. Therefore, locking them up, maybe getting an incentive for locking them up, and then getting via this loan instrument stablecoin minted into existence that is backed then by this locked up asset. The big advantage over fiat-backed stablecoins from a decentralization perspective is that this is a decentralized system which is very transparent. So in case of an open source crypto collateralized stablecoin, any user can audit the code, query the amount of collateral that is being held for backing stablecoins in market, and therefore this is more transparent than fiat-backed stablecoins. One big advantage of cryptocurrencies overall is that they can be basically traded 24/7 around the world in an instance, can be settled in an instance. And this advantage, especially here, accounts for crypto collateralized stablecoins. They can, of course, be traded and settled similar to fiat-backed stablecoins 24/7 in an instant. However, in the case of a crypto collateralized stablecoin, also the collateral can be traded and settled 24/7. So there's basically less mismatch between the collateral and the actual stablecoin in existence in terms of high volatility or in times of high volatility. Of course, and this is something which makes it very hard to structure or to build a crypto collateralized stablecoin, the collateral itself is very volatile. You want to build a stable asset by backing it up with a volatile asset. And we have seen on the first slides that the overall size or amount of volatility can be quite substantial. And therefore, it is hard to build a stable system using collateral in terms of crypto that is volatile. Therefore, typically there's some amount of over collateralization, and also typically if the stable coin is minted into existence via a loan instrument, then there's also a threshold when this stable coin can basically called back in times of low value of the collateral. The one problem of these types of stablecoins, or one difficulty designing a stablecoin system using crypto collateral, is also that the supply of stablecoin does not necessarily match the demand of stablecoin in market. The demand can depend on various factors. It can be depending on how many people want to do transactions with stablecoin. It could also depend on how volatile the market for non-stable crypto assets is, and people want to hold a more safe asset, and therefore the demand can vary substantially. However, the supply of this type of stablecoin always depends how many users or how many providers basically lock up collateral via this loan instrument to mint new stablecoin. One popular example is MakerDAI. MakerDAI is a stablecoin that lives on the Ethereum blockchain. This stablecoin has exactly this mechanism we just described. DAI can be minted into existence by locking up other cryptocurrencies in a contract. In the world of Maker, these contracts are called collateralized debt positions, CDPs, and users can basically lock up ETH, and in a newer version of DAI, also other cryptocurrencies, to mint stablecoin. And of course, since ETH and these other cryptocurrencies are volatile, there has to be some over-collateralization to mint the stablecoin into existence. And then the last category of stability mechanisms I wanted to discuss today in this short overview are Seigniorage style or algorithmic stablecoins. And these stablecoins are a bit different in terms of that Seigniorage style stablecoins algorithmically expand or contract the supply of stable token in order to match the demand. As I said, the demand can be varying, and there's an algorithmic, like an algorithmic central bank, the supply of stablecoin in market is then adjusted. Therefore, this stable asset is basically an elastic supply stable asset. And to mint this asset into existence via the Seigniorage style mechanism, there's then typically a second non-stable asset, the Seigniorage asset. And the volatility of the stablecoin is basically shifted to this Seigniorage asset. Therefore, the value of the Seigniorage asset and also the liquidity then determines the stability of this type of stablecoin. These types of stablecoins have the big advantage that they are similar to crypto collateralized stablecoins, can be built in a decentralized fashion. Similar to them, they are also very transparent, so users can actually have a look at the code. They can have a look at the expansion and contraction mechanism, since most of these stablecoins are open source. The critical part of these stablecoins is, of course, the expansion and contraction mechanism. I want to talk about this expansion and contraction mechanism a bit more in a minute. You can also see here some examples for Seigniorage style or algorithmic stablecoins. One popular example is Basis or Base Coin. This was a stablecoin that was, the development of the stablecoin was actually stopped. And this development was stopped because of the expansion and contraction mechanism. This was one of the problems of this stablecoin. And when we think about the expansion and contraction mechanism, you have to think about demand. And the demand for a stablecoin is, of course, random. We cannot predict what the demand for stablecoin in any stablecoin out there is tomorrow. We cannot even predict what the demand is in an hour. I'm showing here some scenarios or paths from a research paper. I'm going to talk about this research paper in the third part of the series. And here we used statistical processes to model demand. Because in the end, as I said, we cannot predict demand. There can be on a certain day jumps in demand because, for example, a certain regulation came out or people want to support a certain project in a certain country, and there can be a sudden jump in demand. And this jump can also be upward or downward. The bottom line here is demand is random and we cannot predict it. And also the protocol cannot predict it. But the problem is with a algorithmic stablecoin that supply of the stablecoin should always match demand. So if you look at these lines here, the blue line is the demand for stablecoin. And then the green line is the supply of stablecoin in the perfect case. So think about any stablecoin out there with an algorithmic stability protocol. If the demand for the stablecoin that is tracking the value of the US dollar in this example is exactly 20 million, both demand are 20 million in this example and also the supply are 20 million, then the price is actually at 1 because supply and demand are matched at the price of 1. If, however, supply would only be 19 million, but demand is 20 million, then we would see a DPAG. And in this case, since we would have more demand than supply, typically the price should be higher than 1. And now this is the big problem of the algorithmic type of stablecoins. You can't predict what the demand is at a certain time, and you also don't know how this curve basically changes, how steep this blue curve is. Basically, you don't know how the demand function looks like. Basically, in this case here, in this example, we have the strong assumption with supply of 19 million of stablecoin, the price would be higher than 1, and probably here it's 1.1. We have a DPAG, and we could assume that if we expand the supply to 20 million, then the price goes back to 1. Actually, when designing a protocol, you don't know how steep this curve is, how the demand function looks like, and therefore you need a market-based mechanism that matches supply and demand. And probably one of the problems why Basecoin didn't work out is that they tried to match supply and demand via auctions, and in this case, basically you don't know how many tokens you have to auction off or buy back to bring the price back to the peg. In the next series, or in the next talk of this stablecoin series, we will talk about matching supply and demand, how this could work, and how this works on Celo, since the next talk is digging a bit deeper into Celo's stability mechanism. So this slide here is just an outlook. When we dig deeper into Celo's stability mechanism and think about matching supply and demand, we have to think about a market-based mechanism that helps with matching supply and demand. So to summarize what we've talked about different types of stablecoins. Basically Fiat or commodity collateralized stablecoins, crypto collateralized stablecoins, algorithmic stablecoins, and these different types of stablecoins differ in terms of their collateral. Is it basically off-chain collateral or on-chain collateral? And is this on-chain collateral then a crypto asset, or is it a Seigniorage coin that takes up volatility? We have seen different examples like Tether, Maker, or Basis. And we've talked about transparency and governance in these stable coins. The next talk, as I said, will be about the stability mechanism of Celo, which can be thought of as a hybrid between a Seigniorage style based protocol with a crypto or on-chain reserve. This is it. I hope this was interesting. I hope I was almost within 30 minutes, and we are always happy to take any questions on different types of stablecoins. I think you can reach out to us always. Always happy to talk about stability, and I would be happy if you would join the next talks of this series on stablecoins. Thank you.